Alright, it's going to be a long topic for us to talk about today because we're going to talk about inflation, CPI, we're going to talk about FOMC with the summary of economic projection, and also the market is kind of rallying a little bit. Okay, Tesla is going up, Nvidia is going up, but let's be honest here. The market is going up, okay, for the whole entire S&P. It's actually being carried by like that 5 to 6 different companies all the way to the top. Is the market really rallying though? Let's find out. So first, let's talk about inflation. Right, so first of all, CPI is going to be dropping on Tuesday or Wednesday, depending where you're from. Okay, and for inflation to come out, let's talk about expectation first of all. Okay, I believe that expectation for CPI has kind of changed in the recent months, because previously we were always kind of expecting it to be like 0.3%, 0.4%. But I believe that the most important thing that we want to look out for is core CPI, which is core inflation, aka inflation without considering food and energy prices. Why do we need to do so? Core prices basically dictates, your shelter prices, your used cars and trucks, your, friggin' window coverings and things like that. Things that actually have more of a long-lasting inflationary effect on people as compared to just food and energy prices, because that fluctuate a lot, and then you cannot really tell what is the true level of inflation. A lot of people are saying that core inflation, they should actually exclude shelter prices as well. But let's be honest, shelter prices is going to be going down soon. We're expecting shelter prices to be going down in the next 4 to 5 months. I think the shelter prices is already starting to go down a little bit. Okay, that means your rental prices are going to be going down. Prices of actual real estate and houses are also going to be going down. Okay, so expectation wise right now, the market consensus, we're expecting it to be a 0.2% month over month core CPI increment. Okay, of course, obviously, if you were to see 0.4% or something higher than that, I can assure you that the market is not going to like it, because it just means that the Feds are definitely going to be hiking rates. Of course, right now, the entire Fed's consensus right now is that we are closer to a pause than getting a rates hike. A rates cut is completely out of the question because, of course, Jerome Powell talked about it before. We're not expecting a rates cut anytime in 2023. If you're going to be expecting any sort of a rate cut, it will most likely come in 2024. So in 2023, depending on the SEP that's going to be coming out, which is also coming out for this FOMC meeting. Okay, if the SEP actually comes out to be 4.6% or 4.7%, then I think it will be safe for us to actually say that we might actually pause all the way through. Okay, but of course, if the SEP actually comes out to be 5.4%, then we are going to be expecting a few more increases along the way. And that's not what the market wants to hear. The market wants to be bullish. The market don't want to be bearish. Of course, right now I am in quite a bearish stance. And I think it's not really a popular stance to be in right now. It's not a popular position because, Tesla is going to the moon. Tesla just came out with the news saying that they're going to be working together with Ford and GM to join in with the supercharger network. That's going to be changing Tesla completely, because that means that even the legacy automakers are actually recognizing Tesla as one of the leading industry for the superchargers in general, and they want to actually tap into that network. Okay, when that actually happens, it means that GM and Ford wants a piece of Tesla basically. Okay, they were also the ones that were actually saying that Tesla actually have a lot more to grow, saying that Tesla needs to calm down because GM and Ford is the one that's going to be paving the way and so on. Right now, they're just basically coming in and saying that, you know what, okay, we are most likely going to be using Tesla superchargers because it's already so widespread, and we want to ensure that the people who buy our cars can actually have the chance to charge using your networks, be it your F-150s or whatever Chevrolet have to offer from GM. Okay, so let's talk about back to the inflation part. Okay, my macro expectation for inflation right now. Okay, I do think that inflation is most likely going to be going downwards. I don't think there's going to be any peak in inflation anytime soon. I don't see inflation suddenly rearing its bad head coming out in 2024. I do think that we are currently going in this very, very nice trend line for inflation to just kind of settle down. Okay, however, reports from Morningstar actually dictates that they're expecting deflation to happen. Okay, they're expecting deflation to happen for food prices and energy prices. So this is where we kind of differ a little bit. Okay, personally, I don't think deflation is going to be happening for food and energy prices on its own. I do see deflation happening to a lot of other things, such as services. Okay, products on one hand is pretty hard for products to actually have a deflationary trend, simply because product prices usually have this main supplier. Okay, so this is actually kind of like a supply chain sort of issue. Back in 2020, when we had this whole supply crash, where we had so little supply and so much demand, the whole entire supply chain couldn't really keep up with the demands. That was kind of the main issue. Of course, what happened was the supply chain kind of just created more production line. They invested a lot more money into the whole entire manufacturing process in order for them to create more products to feed the demand. Okay, that was kind of what happened during the supply crunch. However, right now I do think that we have enough supply and demand is still going to be about the same. A lot of people think that demand is going to crash and we will still have a huge amount of supply. I don't think that to be the case, especially for products, because prices in products for competitiveness is not as much as services. Okay, services, you're going to be looking at medical, you're going to be looking at insurance, you're going to be looking at mechanical, you're going to be looking at computer repairs, whatever it is, all these different services out there. This is where competitive pricing would actually go down. Because if, for example, the whole entire market is charging $100 for a certain service, for example, someone is going to be charging $80 to cut the market. Someone's going to be saying, okay, someone's doing $80 and I don't have any cost for this service other than my own expertise. And because if I don't really have any other cost other than my expertise, I can actually bring down the value of my service from $80 down to $70 and kind of just fight using pricing alone. That can kind of be how it actually works out. And of course, you can also say that service, at some extent, you do have a supply chain as well, to a certain extent, of course. But I do think that for service-wise, it comes down to labor, it comes down to expertise, and because of that, you don't really have a cost connected to it. And when you don't really have a cost connected to it, that's when you can actually see deflation coming in. Okay, for food prices, as I already explained on a lot of my different CPI reports and a lot of my expectation reports on inflation, I'll just explain it again in this more informative video as a whole. I don't think food prices have the capability of dropping in price. So for example, if today you're going to be going into a fast food restaurant, you're going to be buying a meal, okay, for example, for $10, okay? Chances are, 4 or 5 years ago, you buying the same exact meal is going to cost you like $8, for example, okay? But right now, if you know, right now it's $10, the price would not suddenly just go back down. Because the thing about food prices is that once they actually deem the price to be at $10, for example, let's just take this fast food restaurant as McDonald's, for example. Okay, the cost of the buns, the cost of the patty, the cost of the fries, the cost of the drink, the cost of the actual cups, the straws, whatever it is, the label for the people who are serving you, the label of the person who's managing all the people who are working, all those costs are already added to its maximum. For example, if previously 4 years ago you were to buy a packet of fries, for example, for them, let's just say they were to buy a packet of fries 5 years ago, for example, they would buy it for like $10. Right now, it's most likely gonna be $13. Okay, that $3 extra that that increment in the price, they have to bring it forward to the customers. They cannot just say, oh, you know what, we have an increased price in our supply side. Let's just keep the price as it is, and then we just continue business as it is. No business out there is willing to do so. We're definitely going to be bringing the price down to the consumers. And let's be honest, the consumers are also the ones that with the job, the consumers are also the one that's consuming. So that's where we have the argument for a wage price spiral. Okay, because prices are going up, and because prices are going up, people are not able to afford these items or these consumer goods, what happens is that they'll ask for a raise, and then because of them actually raising, because of their employer actually raising their salary, that actually creates more of an inflationary situation, because whatever company they're working for, they are going to be increasing the prices of whatever products or whatever service that they're actually providing for, and then that kind of just creates this whole spiral. Okay, so when that actually happens, that's where inflation gets out of hand, which is why I do think that food prices as a whole, most likely we're not going to see a huge deflation. Okay, because if food prices have a deflation, chances are that means that you need to also go down on your salary, which that kind of doesn't make sense, because it's going to be the same thing. For example, if you are drawing $5,000 a month right now, if deflation were to happen, for example, if food prices go down, energy prices go down, I don't think your boss is going to just come to you and say, hey man, food prices went down, energy prices go down, so how about this month I'm going to start paying you $4,500 instead. I don't think you're going to accept that, and you're just going to move on. Okay, but of course a lot of people actually call this as a recessionary trend, because when that actually happened, when deflation happened, that means that a lot of time, that means whatever products or whatever services that you're actually selling for goes down in price. The employer need to cut costs, and they will just cut off whatever have the highest burn rate, usually employees, which is why you have huge layoffs. But of course, we have already went through the whole layoff trend session back in 2022. I think in 2023, chances are we're not going to be seeing that as much, because right now, whoever who's still working in tech companies, whoever is still working in the Fortune 500 companies, you can trust that they are one of the most efficient workers, because the company has already done all the trimming. Okay, the companies are done cutting. All those that has already left are the ones that they deem are inefficient. Okay, right now, whoever is going to be left in the company, they are definitely going to be the best of the bunch. So you can tell, Meta platforms, did a huge layoff. Google did huge layoffs. Snapchat did huge layoff. All the tech company basically did huge layoffs. I think Apple was the only one that did not really do that much of a layoff, but they were also the one that did not do that big of a hiring boom. Okay, which is why they don't have to lay off as many people. But yeah, okay, so inflation, that's out of the way. Okay, so let's talk about FOMC. Okay, let's talk about the Feds. Okay, the Feds, chances are, like I said before, the consensus right now is that the market is thinking that they are going to be pausing for this next FOMC. Okay, so what are the so-called abnormal things that might actually happen? Okay, first of all, we have to talk about Bank of Canada. Bank of Canada actually increased the rate hike by 25 basis point. What that actually means is that they are actually higher. The interest rates that they actually have is effectively higher than what the US had back in 2008. This is a very, very important threshold for us to actually look at, because we were expecting every central bank out there, or every central bank that actually it matters to a certain extent, out there, to start pausing in their federal committee meetings and such. Okay, but Bank of Canada decided to continue with its rate hike. And Canada is not that far away from the United States, because they are just basically in the NA region. And for right now, a lot of people are kind of worried that that would kind of also make the Federal Reserve think that maybe they should also just hike another 25 basis point increment. The reason being is because they cannot be complacent right now. Okay, so for example, if they were to just do a rate pause right now, a lot of people are expecting this to be a Fed pivot. I don't really call it a Fed pivot, because I would only expect it to be a pivot when you go from a QT to a QE, aka quantitative tightening over to quantitative easing. I would only expect a pivot to actually take place when you go from a hiking cycle to a cutting cycle. If you're going from a hiking cycle down to a pausing cycle, I don't consider it as a pivot. I consider it just as a change, for example. Okay, if you want to talk about a huge Fed pivot, it's going to be a whole different other thing. That means that the market is definitely going to rally. Okay, so now if we want to talk about the possibility of not even having a Fed pivot, it means that we want the whole market to understand that we are not exactly out of the woods. Okay, inflation is still pretty hardcore. Inflation is still going to be high. Okay, let's be honest. When CPI drops, we're not gonna suddenly just get 3% or 2.5% year over year. That's not gonna happen. Okay, we're still gonna be in the 4%, in the 5%. Okay, and when that actually happens, okay, if you're in the 4.9, 5.2% region, for example, okay, if you're in that region, inflation is still not exactly tamed. And if inflation is not exactly tamed, and you have the Feds coming out to say that, yeah, we're gonna start pausing, and for example, if Jerome Powell comes out at 2:30 p.m. and say that, yeah, we're gonna continue pausing, but at the same time, we're also expecting to continue to pause all the way until we get any other information, until we get to either cut or hike rates again. What that would actually entail means that we are going to be getting an interest rate at that flat line level, okay? That means that the Feds are done. The Feds have completed their job, and what's left to come is for them to slowly cut rates in 2024. When they actually put out the message, saying that their job is done, what that actually means is that people will think that inflation will not, effectively that means that interest rate will not get any higher, for example, which means yield in general will go crazy, or your bonds will go crazy, and your stocks market also will go a little bit crazy as well. Okay, so people might just borrow more money and put into the stock market. People might borrow more money, put into the bonds market, whatever it is. Okay, that would actually screw up a lot of things, and that might actually create this different false sense of inflation all over again. And that means that the Feds might be done. The Feds might think that they're done, but they're not actually done with the job. And that will really ruin everything that they have done so far. They will just destroy all credibility that they have gotten thus far. So I do think that for them to actually come down with a pause, what will most likely happen is they would actually come down with the pause. SEP is going to show that they would have one more rate hike, and then in the last SEP, they are just gonna just bring it downwards and say that, yeah, we're gonna pause all the way. Because if you put one more rate hike possibility in the SEP, what it actually means is that, I don't know, maybe we're gonna be increasing rates next meeting. We might be increasing rates 2 more meetings from now, but we're definitely going to be increasing rates according to the SEP. But the thing about the SEP is that it changes every single quarter, which means that whenever we get new information, when we get different information, differing information that actually helps us think that, inflation is actually going down. If we are actually getting any sort of deflationary trend, it means that we are ready to pause for good, and that means the SEP would definitely be changed downwards. Of course, for that to actually happen, like I said, we will need new information coming in. Okay, so what I think would happen is most likely they're going to be pausing with an SEP showing that they'll still have one more hike for the year. And now, of course, with Jerome Powell coming out to say, yeah, I don't think our job is done just yet. We do want to pause the rates for now and see what the market would actually react to it and things like that. And then possibly in the following cycle, there would be a chance that, we might either pause or we might, increase rates again. That's what I think would happen in the FOMC. Okay, but I'm definitely going to be quite excited to see what happens with FOMC. It is quite an interesting thing especially for this current meeting alongside with the CPI. I think this is effectively one of the most important one of the year because this is where we actually see, are we going to be hitting 2008 highs for interest rates, or are we finally going to be treating the 2008 interest rate as the threshold as we go downwards from here on out? But anyway, that's all I have for this video. Thank you so much for watching, and I'll see you guys in the next one. Thanks for listening thus far. Bye. Yeah.